Are you looking to consolidate debt, maybe do some home improvement? You've got a lot of equity in your home, but you don't want to touch your first mortgage rate because it's a lot lower than rates right now? Well, you're not alone. And we help people all the time. I mean, all the time right now with either getting a home equity line of credit or a HE loan. Now, what is that? A home equity line of credit or HELOC is basically a credit line that's fixed to your home and in second position behind your first mortgage. So you can have that great COVID rate, right, that you got in 2020 to 2022. And then you can go ahead and pull cash out of the equity you have remaining and get a lower interest rate loan than you would have on your high interest rate credit card. Now, revolving credit card debt sits at record levels of 1.26 trillion and auto loans have reached 1.71 trillion. So it's like 3 trillion in debt right now of auto loans and credit cards. Meanwhile, equity has reached an all-time high of 18 trillion. So if you're one of those people sitting on a lot of equity, this could be a great solution for you. So again, there's really two primary options. You can do a home equity line of credit, and what that looks like is it's a revolving credit line, meaning it works similar to a credit card, except the loan is tied to your house and therefore carries a lower interest rate than credit cards would. Pretty much like 3 times lower, I'd say, about on average, maybe even 4, depending on the card and the rate you're getting on your HELOC. Now, what's cool about a HELOC is you can borrow, you only pay what you owe. So you can have a $100,000 line of credit and only owe $50,000 on it, and you're just paying for that $50,000. Then you can go ahead and pay off $10,000 and then pull out another $5,000, as things change in your finances and you have projects coming up, maybe a vacation you want to finance this way as opposed to spending credit cards. It's a smart way to go. Second would be the HE loan. Now, a HE loan is pretty much a fixed rate mortgage. They're often 10, 15, 20, or 30-year terms, really just like a first mortgage. But the terms are fixed. So let's just say, again, if you have to pull out $100,000, the day we sign loan docs, you pull out $100,000, that's your money. And then you pay your mortgage payments over the next 20 years, 30 years, et cetera, or until there's an opportunity to refinance, you sell, whatever the case may be, you pay it off. But it is fixed and you have monthly payments, very predictable, very stable for the remainder of the loan. We see different reasons people get different things, but we do a lot of both of these options. I'm happy to discuss them with you. I actually had a lady recently contact me who was paying over $2,000 a month in credit cards. And when we finished getting her home equity line of credit, it was under $300 a month for what she owed $2,000 a month for. Just a complete game changer. She's thrilled. I think her interest rate on her first mortgage was 2.875. She still has that. So it's a great option. I'm Garrick Wordmuller, President CEO of Fresh Home Loan, independent mortgage brokers that work for the people. We're here to help you, your family, and your friends purchase, refi,